Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, and this is a special edition of Market Today, where our focus will be on the Q3 earnings. And the latest firm to report their earnings from the IT pack is HCL Technologies. On Thursday, it reported a 19% year-on-year growth in the consolidated net profit to 4,096 crore rupees. The revenue for the quarter also grew by 20% on a year-on-year basis at 26,700 crore rupees. Sequentially, also we've seen the revenue rising sharp by 8% and the profit by more than 17%. Now, to discuss more fine print about the earnings and the outlook going forward, I'm joined by the company's top management. Prateek Aggarwal joins in. He's the CFO at HCL Tech. Welcome, sir, and thank you so much for taking the time out. Here's wishing you a very, very happy new year. It started off on a strong note for you because there's a strong show despite the seasonality factor, and you've been able to beat most of the estimates, especially the revenue and the margins front in Q3 as well. Help me understand what led to this performance, and more importantly, can it be sustained going forward?
Thank you very much, Sakshi, for that very nice introduction, and very happy new year to you and all the viewers. So yes, this has been a quarter of 19s, like I called it. 19.6 growth in the top line and 19% growth in net profit. And this quarter, we actually crossed two very nice round figure milestones. So we crossed the 5,000 crore mark in our EBIT this quarter for the very first time, 5,228 crores. And in our net profit, profit after tax, also we crossed the 4,000 mark for the very first time, close to 4,100 crores, 4,096 to be precise. So a very, very satisfying quarter. What drove it on a year-on-year basis, the growth in our services business has been fantastic.
Yeah.
That grew 22%, driving the 19.6%. Our software business was flat after taking out the impact of the divested IP partnership that we had with DXC. So services business clearly take the growth leadership there. As far as margins are concerned, this is a very seasonally strong quarter for the products business. Seasonally a little weak because of the holidays and furloughs and things like that.
Yeah.
So that provides a very nice complementarity at a company level, that the two businesses sort of have a different seasonality which complements each other. So that has been the great part. On a sequential basis, like you said, 5% growth was largely because of the 30% plus 30.5% growth in the products business. Services business also grew well at 2.2%, given that it is a seasonally slightly softer quarter because of those factors.
Absolutely. The deal wins have also been quite strong. The company won about 17 large deals, of which the 7 were in services, 10 in the software verticals as well. Do you see the momentum continuing from here? Or are there any signs of, say, the slowing down, pricing pressures, client budgets shrinking right there because of the overall macroeconomic concerns that we've been looking at, going forward from here?
So the macroeconomic concerns have been there for some time. And despite that, I think if you were to look at our last almost 6 quarters, 5, certainly maybe 6 now, we have had a very steady, slightly increasing, band of 2.5 billion every quarter on the trot. That steadiness is again very heartening because, you don't really necessarily like those ups and downs. Ups everybody likes, but downs are not so welcome.
Absolutely.
But we have had that very steady line, and our pipeline continues to be good. We have a good recognition from the industry analysts as well. Like we said in the quotes yesterday, we are the only company who is in the leaders quadrant of all the 6 magic quadrants that Gartner publishes. So that positioning, the passion of our people and our pipeline and our whole set of solutions, I'm sure will continue to hold us in good stead, even in the next few quarters. I don't see us dropping outside that band, hopefully.
Okay, and the order book also grew 10% year on year to $2.35 billion right there, increasing on a year on year basis as well. But sequentially, I think there was a slight dip, about 1.2% on that from the $2.38 billion that we had seen last quarter. So is that just like a one-off? We'll see that continuing going forward?
I think we are continuing to show good deal wins, which is what we had mentioned also, that deal wins this quarter will be decent. 2.4 versus 2.3, it's a small, it's the steadiness across those 5-6 quarters, which is more important, which is the heartening part.
Right. So in terms of, the verticals performance, we did see the largest business vertical for you, financial services, witness a slight dip, a growth in CC at 1.7%. Any softness, or would you have anything in mind that is right now pointing to a concern, to a slowdown in terms of verticals going forward? Any softness right there?
Not at all. Not at all. This quarter, there were some furloughs, like we had mentioned earlier also in December. Which is what resulted in that slight negative on the financial services. Our other big segments, verticals like technology and manufacturing, etc., continued to do well. There was some impact of furloughs, but the large deal that we announced last quarter, the mega deal that we announced, as well as the deals that we announced this quarter, put together is more than $1 billion of net new deals across the 2 quarters in the financial services vertical. So going forward, when those revenues start coming in, part of it will come in this quarter, very small part probably, but the larger part, the full quarter impact will come in the June quarter. So by June, I'm quite positive this will be a very healthy number.
But can the furloughs extend or spill over to the next few quarters?
No, furloughs is typically linked to the holiday season. And therefore, in the Western Hemisphere, it's more around Thanksgiving and Christmas, really. And as far as Asia Pac is concerned, the Chinese New Year happens in January, so there will be small impact like every year, I guess. So we'll have to take that in a stride like we always do.
Okay, a few questions there on the hiring trends, the attrition trends as well. Headcount addition had actually slowed down this quarter to about 3,000. What is that on account of, and does it indicate any slowdown in growth right there? And what could be the other factors that could actually lead to this slowdown going forward? Also, if you could help us with the hiring trends in the next few quarters that we can expect.
So I won't be able to talk much about the hiring trends for the next few quarters. We'll come back and give the guidance for FY24 1 quarter later. But so far, I really wouldn't call it a slowdown for the simple reason that we are still positive net hiring. 3,000, yes, but as far as freshers is concerned, we actually hired 6,000. And freshers over the last 12 months continues to be a number near that 30,000 number that we talked about. So I prefer to look at it, the fresher numbers that we are hiring every quarter is the more important number, because that's the fresh talent which will continue to grow over the years and stay with the company a whole lot longer, I would expect. And that's and on a total basis, the net number is that 3,000 number. It was about 8,000 last quarter. And so you have to kind of take it in a cumulative sense. Just looking at 1 quarter can go off the charts. That volatility will be there. We are also focused on improving our margins, right? So that efficiency, the utilization of the people has to improve the margins. because that is frankly our biggest cost line item. So some of that, and obviously, for several last quarters, we were growing at 5% in our services business. This quarter, it is 2.2%. So to that extent, it is in line.
So are you going to be using only this as the lever to expand your margins going forward? Or are there going to be any other levers as well?
So given this is the biggest cost line item, it will always be number one. There are others, of course, like third parties that we use or the outsourced services that we use and so on and so forth. Travel and those kind of factors are always there. But this is like more than 50%, 53, 54%. So ultimately, it does come back to this largest line item.
Sure. And the rate of attrition has also narrowed to about 21.7% in this quarter compared to 23.8%. So there is a considerable dip right there. Where do you expect this to cool off to going forward? What would be your own comfort limit right there? And is this encouraging enough for you to now focus on the utilization rate?
I think the two metrics and drivers have to be measured and driven every quarter, every month, and every week, practically speaking.
Sure.
The attrition will continue to go down. In the first instance, I would at least like to see it go down to 16-17%, which used to be our pre-COVID kind of a level, and then hopefully it goes below that kind of a level as well. But that we'll have to see. We always want attrition to be lower, as low as it can be. So that's how I would respond to that.
Sure. And what's also very interesting to see is that Europe has really led the growth for you with 7.2% growth in this quarter on a constant currency basis, followed by Americas as well. But looking at the major concerns emerging from Europe, can that continue, the kind of growth that you've seen from Europe?
Yeah, that is a very robust number driven by the deals that we had won in the previous 2-3 quarters. So, and some of that is also linked to the supply chains easing up, right?
Yeah.
So that also helped. Going forward, I mean, the war, it's next month, 24th is going to be a anniversary of the war. So, and those factors have been there for quite some time. If you look at it, it's almost 11 months already. So, yeah, I mean, we continue to do business and customers continue to make decisions. Few customers at some time might delay some decisions, but at the end of the day, they need to keep their companies and businesses working. So, yeah, we are very happy to see that growth.
Okay. And also on the guidance front, we did see a slight tweaking of that, although you had said previously also that you'd be looking at the lower end of the guidance. But is there any more further downside risk going forward from you in the next few quarters? Can it be revised down?
The guidance is what it is, what we had said 1 month back in December as well. So that's the only thing that is reflected there. People tend to compare it with what we said in October. But they forget that what we said in December came after that. So, so it's reiterating what we said in December. There's nothing new. For going forward, we'll come back next quarter and tell you.
And EBIT margins at 19.6% that have been the highest in 6 quarters. Can it be sustained, improve going forward, and can it reach the peaks that we had seen pre-COVID as well?
It should certainly sustain in the December quarters of every year going forward. But it is a seasonality factor from the software business side. So it would be, I mean, that's why we publish the services margin separately. And, we publish it for all the segments, of course. So services actually also grew very well in margin terms this quarter. Despite 70 basis points impact from the salary increments that we gave to our middle management this quarter. So it grew at 10% after, 10 basis points from 17.6 to 17.7%. after taking that impact of 70 basis points. So the underlying the margin growth was actually 80 basis points.
Okay, well, on that note, thank you so much, Mr. Aggarwal, for being with us and speaking to us about the earnings and the outlook going forward from here. All the very best to you for the upcoming quarters. A very strong show. Congratulations yet again, and looking forward to greater performance, better performance in the coming quarters as well.
Thank you very much, Dr. Sakshi.
If you like the video, do like, comment, share, and subscribe.